Well, hi, everyone, and welcome to the Buffett and Beyond Saturday Market Recap. And this is January 10th, 2026. Yes, we're into a new year. And remember, folks, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And the market, a new year, and the Saturday rally continues, and I'm saying that tongue-in-cheek, so to speak, but the S&P inches to new highs. And actually, we continue to be in a bull market, so this is all part of a bull market that has gone on and on because the economy is doing fairly well. Oil prices are dropping. Interest rates are going to be dropping this year. And so as the year goes on, we think the market is going to continue to go to new highs, maybe little by little, but as the year goes on. In our weekly stock analysis video, well, we looked at the transportation stocks, and there's only two companies which are doing well, one of which is Uber. Yeah, with ride sharing, Uber food delivery, and soon to be autonomous cars, or taxis, I should say, this stock is doing very well. So let's take a look and see what the numbers are telling us. And with our ETF video, well, we have last year's results and this year's changes in the tech and semiconductor area. We also look at the 7-year results in the tech and semiconductor sectors. We also look at the changes in the top healthcare sector. And of course, healthcare has been in flux this whole past year and even before a little bit because changes are going on in the prices of medicine, changes are going on in the healthcare sectors and Medicare and on and on and on. So everybody's not sure exactly what to do with healthcare. So it didn't perform. So it performed actually fairly well last year, and so did our top stocks in it. But we're going to see which stocks we're adding to that healthcare sector. And let's look at the S&P 500, and we're looking at the volatility bands. And so let's come up over here, and we can see the market had a very strong Friday. Yeah, this right in here with the S&P up 44 points, or 44.82 points to be exact, and we're closing in at that 7,000 level. And as you can see, we're at new highs. But you can also see that we're just barely above the area we were 2.5 months ago. So really, we're kicking at that top there, pushing that top up a little bit. And we think the rally will continue, but we may have a reversion to the mean here because this middle line is the 20-day moving average. And you can see every time the market gets too far above that 20-day moving average, it comes back down again. And between October and November, mostly in November, we had this S&P go to a new high and then drastically come down to hit this bottom band, back up again with a nice rally, which sucked everybody in, and then it had a big drop, which really scared everybody, because if you could see right here, this market closed below that bottom band. That was a tough, tough day, and traders look at that. And then all of a sudden, the next day, the market rallied. This is this black line right in here. And we can see the volume was higher than the down volume on the previous day. And that kind of gave a hint that we would have a rally in here. How long would it last? Well, it lasted a couple of weeks. And then we had a reversion to the mean once again. And a little scary point in here before it came back up again. And then we went to the top of this band, back to the 20-day moving average, and now we're near the top band once again. So we'll see what happens this coming week. Oil prices are dropping, interest rates are going to drop. Everything's looking pretty good for the market for the whole year. We may have some fits and starts. We see some rotation going out of tech for at least a few days at a time, and then into other stocks, once again, the stocks that have been beaten up, consumer stocks, really. And that rotation is good. We'd like to see all the stocks participate, aside from the Mag 7, which represents something like 30-something% of the S&P index. So there's another 492 stocks out there, or 493 stocks out there that should be participating in this rally. And some of them are, that have to do with the building and the infrastructure for AI and also electricity. We have to figure out how to get the electricity from here to there. In other words, from the utility plants to these plants that they're building out there, which utilize an awful lot of electricity. Volume down here is pretty good. The green vertical lines represent the volume on the up days, and the red lines represent the volume on the down days. So when we had this one down day on Wednesday, it wasn't a heavy volume day. And then the next day, the green lines continued. So we're stuck in this pattern, which is pretty good. And down here, it looks like this indicator is now turning positive once again to the upside. And we're looking at this black line crossing over the red line in here. And so this looks positive also. Now, when we look at another indicator, so this is the same chart without the volatility bands, we can see the market is above the 20-day moving average, above the 50-day moving average, the blue line, and maybe a reversion to the mean in a couple of days. But up here, we're seeing this one indicator, which is a stochastic indicator. And what stochastic represents is how often does the market close the day in the upper half of its trading range. That's what the stochastics measure. And so we see a fall off here, and we'll see what happens if next week this black line cannot turn back up. Then we have a little sell signal in here. But, you know, the sell signals in the past have in here, it's been pretty ferocious if you've been involved in this, if you look at your portfolio every day, so don't do that. And we can see this was pretty nasty in here, and then it rallied, fell down. So we're getting these back and forths, but of course the general trend is up. But again, for the past 2.5 months, we're only up a couple of points. So it's maybe 2% over the past couple of months, which is not too bad. Not too good, but it's not bad. So this is pretty good. We want to stay fully invested at this point. Now, when we come down to portfolio protection, we have 3 puts for a more or less $200,000 portfolio. Now, a lot of you don't use these put protections as long as the Federal Reserve is kind to the market by being not aggressive on interest rates, but being dovish, as they call it, on interest rates. And the Federal Reserve is looking at the job formation. Is business expanding? Well, here's the thing. Business is expanding. But business is not hiring more people to do that, because AI is really helping companies be more efficient, whether it's in their writing, whether it's in their analysis. And so fewer people are needed to do the same job. But efficiency is increasing, so the GDP is increasing without the hiring of new people. But the good side, the very good side of this, is they are not firing people. So job creation is a little bit lower. Came out, the government numbers came out on Friday, and the job creation a little bit below where they expected, but there is still job creation going on. And so as long as the economy is growing slowly, but the GDP is growing faster than the hiring of new people indicate, because we're in a whole new era, folks, with AI and computers operating much more efficiently than they did a year ago, 2 years ago, and certainly more than 3 years ago. So a lot of you were saying, we really don't need this portfolio protection, or we only need one of these puts. And then if the market does start going down, we'll add more of the puts. So that's one way of looking at it, and that's not a bad way of looking at it. And then the QQQs, 626, and over the past actually 3 weeks or so, the QQQ is about up 1.5 points or 1.5% over the past 3 weeks. So it's not doing much, but it's positive. And so we're looking at puts, and a lot of you were saying we really don't need puts right now because everything is going pretty good, or we'll just have one of these puts instead of 3, and we'll add more. And some of you with portfolios more than $200,000, you say, well, I'll have a few puts in there just to have some kind of protection in there. And so many of you say, no, we're in a bull market, so let's forget about the puts. So it's up to you and up to each individual, and we'll see what happens as we go along. But those of you who want put protection, these are the ones we have. These are the costs down here. And we like to sell a couple of cover calls and things like that as we go along, or it's just part of the expense of being in a bull market and having a portfolio that is making you money. As if you subscribe to the ETF section of this, we show that in the ETF letter that the semiconductor and the techs are just unbelievable numbers. And especially over the past 7 years, up almost 1,000%. And I'm talking about our top stocks in the tech sector and the semiconductor sector. Both of them are up close to 1,000% over the past 7 years. So we have 2025 numbers factored into that. So those are portfolios that a lot of you like to cherry pick, some from the growth portfolio, some extras from the semiconductor sector and the tech sector. So yeah, those of you who are putting your own portfolios together are doing really pretty well and using these stocks and using the clean surplus methodology. So folks, here we are at another weekend. Go out and enjoy it. Most of all, be safe. Be with your family if you can. Take your mind off the market because it'll be back open on Monday, and we'll be right back here with you in a couple of days.